We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We are looking at futures that are off 2.5% after yesterday seeing the biggest drop in the cash trade in 5 years. NASDAQ futures down 2.8%. Russell 2000 futures, after the index has gone into an official bear market, down 22% from its high, off another 4%. So there will be blood, as JP Morgan's Bruce Kasman said in his note today. You can see RBC Capital Markets ringing the bell at the New York Stock Exchange today, celebrating a 31st anniversary of some hockey charity or something. Microsoft down at the NASDAQ celebrating their 50th anniversary in a pretty scary reminder that I am older than Microsoft, Katie. So that doesn't matter today. All that matters is the sell-off we're seeing and in stocks and the buying that we're seeing in bonds.
Absolutely. Let's talk about the stocks first, because I want to take a look at the likes of Apple and Tesla, Alibaba, all linked to China. Remember, China added a 34% tariffs on all American imports starting on April 10th. That was announced earlier today. We just got a response from President Donald Trump on Truth Social posting that China played it wrong. They panicked. So not exactly a free-flowing negotiation just yet. You can see that those sell-offs that we saw materialize yesterday, gaining steam today. Apple down 3%, Tesla not too far off, Alibaba down nearly 9%, Matt Miller.
All right, we are watching other sectors, including retailers. We see continued slide from Nike today after the company was decimated again yesterday, now down 4%. Energy also, as we see the underlying oil price absolutely crater, we see the energy producers drop as well. We're looking at NYMEX crude, by the way, under $62 a barrel right now, so Occidental is off. And then banks continue to fall. JP Morgan Chase is one here. But you can look really across the KBX and see that they're all down. JP Morgan off 6%, all deep in the red following that Chinese retaliation news. We're back with BlackRock's Rick Reeder. And Rick, let's dive into this trade war, which is kicking off. I guess the Trump administration put massive tariffs on China. China is striking back with massive tariffs on the U.S. How does this play out for our economy?
Listen, I mean, in the near term, and similar to what we talked about, there's a lot of discussion about recession. And, the way we define recession is interesting. You get a couple of quarters of negative growth. What I actually think is happening is you could have a downturn because of people sitting on their hands. That could be pretty intense over the short term. I don't think it's, quite frankly, I don't think the timing is at 2 quarters or 3 quarters or 1 quarter of softness. It's the intensity of how much do people sit on their hands for a while. So, listen, I think it's going to be, we're going to have a softer period. I think you have to build that into your asset allocation, how you run risk, because we're not going to know, at least for a few weeks, what the ultimate outcome is. When will corporate CEOs start to do more in CapEx, R&D, M&A? Well, my sense is it's going to take a few weeks for that to play out. But I think you have to build in any portfolio. There's going to be a soft patch.
All right, so you're saying a softer period, a soft patch. I want to go to a note that came out this morning from George Saravelos over at Deutsche Bank. He wrote that the market is doing one thing, pricing in a global recession. Rick, it sounds like you don't quite see that yet.
So, no, I see some significant slowdown in the near term. Like I say, whatever we call it or whatever we term it, I think you got to manage your risk. I talked about it last week, the week before. I think you got to pull back on risks that you take within portfolios. And I think you're going to see some tangible slowdown in terms of, what orders go through, how do companies think about their inventory development, how do they think about what cost of goods sold is going to be, what does it mean for margin, do you have to start to make some inventory adjustments, CapEx, people adjustments. So, listen, I think your portfolio has to reflect that there's going to be a weak period. And, right. The question of defining the durability of that, I'll say one thing that's very different when people think about spending. CapEx you put in place for 5 years, 10 years, sentiment can change amazingly quickly. And so we're in this period where sentiment now is going to be really tough. That can change. And so I think you got to think about, how do you position, what are the conditions that you'd operate in where sentiment, my sense is sentiment will change quite a bit, whether that's a month from now, 2 months from now, or 6 months from now. is going to be the key for markets.
Well, Rick, is that what you're doing? Because if I take a look at BINC, of course, that's your ETF, I see a 9.5% allocation to investment-grade corporates. Then I see a nearly 38% allocation to high yield, which certainly we've seen some cracks start to form in the corporate credit market. Should we see some of those come down in coming days?
So I think if you study what you do, I think you'll see those having come down. But I will say one thing about, the one thing about positioning around, the things you do a week before, 2 weeks before tend to be your best, how you manage a portfolio. Increasing some of your interest rate exposure, bringing down some of the lower quality parts of your portfolio is definitely what we've been doing. And by the way, if you think about single B high yield in the U.S., double B in Europe and the U.S., those credit conditions should be okay. Managing that and putting some hedges around it, including some interest rate. If you look at performance of how a portfolio like this did versus the high yield market, that's why it holds up so well.
I look at, all the enthusiasm that we had coming into this year, Rick, was about deregulation and tax cuts, right? And it doesn't seem like the M&A guys are seeing the kind of allowance that they were expecting. And then in terms of taxes, JP Morgan's Bruce Kasman says this tariff hit, a 22% all-around tariff on imported goods, represents the biggest tax hike the U.S. has seen since 1968. Even I wasn't born yet in 1968. That doesn't seem like it's great for animal spirits, especially when Republicans are also talking about actual tax increases. Yeah.
I was born before 68. So the one thing I will say, listen, I think I said this last week. I think the dynamic of we've gone from animal spirits to animals in hibernation, and that's where I think we are. I think it is literally just hold off and wait and see what all these things that play through. I think companies are going to have to make significant adjustments. If you're a multinational, how you think about your supply chain, how you think about your distribution function, how you think about assembly. I think all those things are going to change, and that's why we're in this period that I think is to make decisions to add a lot of beta or think about risk today. I just think you got to be conservative. I think, I said this, I think you got to hunker down for a bit of time here.
I was in a Bloomberg chat with some private equity companies yesterday, and their portfolio companies are not going to be able to relocate production into the U.S. and are going to have to essentially double prices. That just isn't going to work for so many manufacturers out there. Do you expect these tariffs to somehow go away?
So, Matt, the thing we were going through today that is fascinating. So there is a transition. So, it's all about elasticities and the reaction function. And so we were trying to think, well, what is nominal GDP? If you slow down real growth, do prices stay exceedingly high because you've got these tariffs? And so your nominal GDP stays high because you've got higher prices and higher inflation. My sense is that doesn't capture the elasticity around it, meaning what will happen is companies will have to reduce prices. You're seeing that in some of the retailers, more promotion, more couponing. So I think what will happen is companies, the first reaction function, I'm going to pass through price. Maybe I don't pass through all of it. I'll absorb some in a margin. I'll try and pass through some. My sense will be you won't be able to pass through that much, which will denigrate your ability to actually get that price, and you'll start to see prices come down. So I think what will happen is you'll see volumes come off, and then you'll start to see prices will have to come down, or you just won't sell the volume. You just won't move the inventory you need to move. And listen, there will be some, there's no question, there will be some manufacturing that will relocate. It just takes time.
Right.
There'll be some distribution chains that will change, no question about it, depending on how people respond. And so, companies are going to try and keep that margin up. I'll throw out one thing that's hugely important. They're going to move faster towards productivity, automation. How do you make your business more efficient in a bunch of different ways? And that's the next trade that I think you got to put on.
And I do want to point out we're keeping a close eye on Apple, down about 2.5%, actually falling below that $3 trillion threshold on market cap. So these superlatives coming in quickly. I do want to end by talking about treasuries, because clearly obviously, there has been an enormous bid into the bond market, Rick Reeder. You know that well. But you have seen some notes out there, some worries starting to form that if this really continues, this trade war, and this deepens and escalates, whatever word you want to use, that you could see international buyers of treasuries step back even more than they already have. We know that China's holdings have been going down. We know that Japan's holdings have been going down. But do you think that that's a chip that's potentially on the table here?
So, tough one. So listen, I think that there's a series of timing things to all these things. You know, we've talked about, we love the front end of the yield curve. You're pricing in a lot of cuts today. We've been taking some of our duration further out the yield curve for a variety of reasons, what it means for notionals, et cetera. But I still think, we talked about, we've added some interest rate exposure, been pretty significant. The front end now has got some, how do you think about the front end? How much can the Fed go if inflation is this high? But anyway, holding interest rate risk makes sense. The longer term paradigm is incredibly important. Part of why policy has to bring the debt down, part of why spending has to come down is exactly like you say. We've relied on international purchases of our treasuries for so long, and those countries, forget whatever retaliation is, those countries have to fund their own domestic. If your own domestic economy is going to slow, you've got to fund your own, you've got to issue debt in your own domicile, and that is a big deal. So yes, I think you have to be really sensitive to that. It's part of why we need to reduce spending in this country. We need to manage the debt stack in this country because it's too onerous.
All right, Rick, great having you on the program. Really appreciate you spending so much time with us. BlackRock's Rick Reeder, also the manager of BINC.
Yes,
an
yes.
ETF that Katie watches very closely.
Well, it's grown pretty mightily since its launching. But I do want to point out, I liked your question about animal spirits because they've been nowhere to be found. Rick said that this is animals in a hibernation sort of mode. Do you know what animals hibernate?
Bears.
Bears.
Yes. Very good point. All right, so hopefully they can stay away, but we're not far off of bear market territory, right? We're down, 15% now on the S&P from
Somewhere
the high.
close to that, yeah.
Getting very close to bear market territory in the NASDAQ, and of course we've seen it on the Russell 2000. Coming up, we're going to talk about pharma, avoiding Trump tariffs, at least for now. We'll look at the sector and top calls next. This is Bloomberg.
Welcome back to Open Interest. You take a look at stocks 15 minutes after the bells ring. Losses deepening right now. The S&P 500 now down nearly 3.4%. We were already heading for the worst week since March 2020, and those losses just keep coming. We'll keep a close eye on that because you take a look across the indexes, the NASDAQ 100 down a similar amount, and the Russell 2000 really bearing the brunt of the sell-off. This index already in a bear market, and it's just getting worse. Now down about 4.5%, but it's time now for our top calls. Some of the analyst action in focus this morning, and first up, one of Wall Street's most bearish Tesla analysts is getting even more bearish. JP Morgan's Ryan Brinkman is cutting estimates for the EV maker's earnings, citing unprecedented brand damage thanks to the Elon Musk backlash. Next up, we have Citi downgrading Kraft Heinz to a sell ahead of its earnings. The analyst citing growth struggles and margin risk. And finally, car parts retailer Genuine Parts getting upgraded to a buy over at Evercore ISI thanks to its insulation from tariffs. The analyst says that earnings may move higher actually because of tariffs. The stock right now is unchanged. I also want to take a closer look at pharma stocks. That's after the industry survived any sector-specific tariffs in Wednesday's announcement. But President Trump yesterday told reporters that tariffs may be coming soon.
The pharma is going to be starting to come in, I think, at a level that you haven't really seen before. We are looking at pharma right now, pharmaceuticals. It's a separate category. And we'll be announcing that sometime in the near future, not too distant future. That's under review right now.
Let's get some analysis now from Emily Field. She is head of European pharmaceutical research over at Barclays. Emily, it's great to speak with you again. And just set the scene for us. Any supply chain in any sector is going to be difficult to untangle from how globalized they actually are. But that feels especially dramatic when you think about the pharma industry.
Yeah, and I think what is just such a sweeping change for us looking at pharma on the investment side is just that, you know, as President Trump said, unprecedented territory. Pharma has been essentially immune from tariffs due to a WTO agreement from 1994. So it's just something that we have never even thought we'd ever have to consider. And now, obviously, it sounds like this is coming down the road. We're trying to do the analysis and have sought guidance from all of our companies. But, you know, we're still at very sort of high level thinking about the impacts as it's so difficult to quantify.
How hard is it? I mean, I know that we have some workers coming back to the Health and Human Services. Maybe the FDA doesn't lose nearly as much staff as we feared, but there's still going to be a slimmed down workforce. How hard does that make it for drug companies to get things through and to get, you know, new advancements out to the public that needs them?
Yeah, that is a super salient point. And to be honest, me personally, that's what I'm more concerned about impacting the space rather than tariffs. You know, pharma products are still going to get made. These companies have very, very high gross margins, so they can absorb some cost increases. However, this is totally unprecedented at FDA. You know, high level people at the organization that investors know about have left in the last week. Will this delay drug approvals? To be honest, we just do not know.
And I want to talk a little bit about specific companies. Novo Nordisk obviously is in your coverage universe. Novo having a really difficult start to the year, down 28%. And you think about Novo with its blockbuster obesity drugs, its biggest market is the U.S. I mean, when you think about the global impact of any specific sector tariffs here, I have to imagine that Novo could be in for more pain, Emily.
Yeah, and it certainly has been a painful period for Novo shares. And I think, you know, it is getting sort of isolated as a potential tariff loser, if you will, given we know the supply chain because it's really centered on one drug. They make the raw semaglutide mostly in Denmark, although the filling and finishing is done elsewhere. And then, of course, Greenland, which is part of Denmark, seems to be in the headlines. However, you know, what we're really looking for with Novo is will obesity prescriptions start to rebound after the phenomenon of compounding, what Hims and Hers is doing in the U.S., is set to expire at the end of May. So that could be what we're all looking for as a potential turning point.
In your coverage universe, Emily, how much production is moving back to the U.S.? How many companies that you cover are saying, all right, in order to avoid tariffs, I'm going to bring all my drug production back to the United States of America?
Well, in terms of what we've seen from companies thus far, Johnson & Johnson, Eli Lilly, and Merck have, issued press releases saying, oh, we're doing this incremental capital investment in the United States. None of the ex-U.S. companies have done that yet, although maybe that happens in the future. But the thing with pharma production is they're very, very long lead times to build facilities, and they're also highly regulated. So, you have to have some certainty on how long this tariff picture is going to play out. And then also, you're going to need FDA inspectors to inspect any new facilities that you're building. So in terms of where CapEx goes, that's still just another huge question mark.
And Emily, it's interesting how grim things feel in this industry right now relative to mid-January. I was out at the JP Morgan Healthcare Conference in San Francisco, and one of the big themes was we're going to see all of this M&A, we're going to see this merger activity, some consolidation in the space, all of those tailwinds that were kind of anticipated at the beginning of the Trump administration. It just feels like they've totally gone by the wayside.
Yeah, absolutely. And we were certainly expecting with the change at FTC, we know FTC had taken a pretty draconian view towards pharma consolidation under the Biden administration. All our large cap companies have very healthy balance sheets. We were expecting really significant M&A to pick up in 2025. But I think the uncertainty created not only with tariffs, but also with what's going on with healthcare policy under RFK Jr. at HHS, I think has led all these companies to just really sit tight and see what happens. We actually, given the policy overhang, downgraded pharma to neutral back in January, right after JP Morgan, as we thought this policy uncertainty would be a drag probably until about the summer.
All right. Emily, thanks so much for joining us. Emily Field there from Barclays talking to us about what to expect in the pharma industry. Let's get a quick check on stocks as the S&P, the NASDAQ, and the Russell 2000 continue to fall. We're looking at a 3% drop for the S&P right now, so not nearly as bad as what we saw yesterday, but it does look like if we stay at these levels, we'll close out the week down 6% for the S&P 500. The Russell 2000 in an official bear market now, off about 25% from the high that it posted in November. This is Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Quick check of what's going on in stocks. We are down really across the board. The S&P 500 is off more than 3%. So it is now off 15% from its peak at the end of February. The NASDAQ down 3% as well. The Russell 2000 has lost fully a quarter of its value, 25% from its recent high. In terms of the individual movers, NVIDIA down 4.33%. You know that's a big heavyweight drag on the indexes. Apple is now worth less than $3 trillion. We have losers in DuPont, in Alibaba, Tesla leading the automakers down, but Stellantis is not far behind it with 6% drops at these two automakers. It is not a bloodbath. We're not looking at panic, Katie, but at one point this morning it did feel like we were going to be.
Yeah, absolutely. I mean, you think about the VIX hitting 45 on an intraday basis. That's only the highest level since about this past summer. But if you take a look at closing bases, then you have to pull out to a 5-year chart. So maybe it's not panic yet, but some of the measures that we were told to watch, it's the VIX, it's credit spreads, they're starting to get a little bit hairy. So not panic yet, and it'll be interesting to hear from Jerome Powell himself in the 11 a.m. hour, though there's a lot of questions out there about whether Fed policy can really offset the economic hit that might be coming.
Yeah, we'll talk about that economic hit with Claudia Sahm. She joins us in the next hour. This is Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is on assignment. And coming up on Open Interest, the carnage continues. Stocks plunge as President Trump doubles down and blasts China for retaliating against his sweeping tariff plan. A strong labor data print did little to mitigate anxiety about the impact of the trade war. Fed Chair Jerome Powell takes stage next hour. And Wall Street rips up its playbook. We'll hear from billionaire Howard Marks of Oaktree Capital today on open interest. All of that and more coming up. Let's get a check on these markets right now. As I said, carnage. You can see the S&P 500 down 2.8%. We're off the lowest levels of the session, but still shaping up to be the worst week since March 2020. Take a look at the NASDAQ 100. Big tech has really been in the crosshairs of a lot of this damage, down about 2.7%. There's still a bid coming into the bond market, but it's been lessening throughout the morning. But nevertheless, the 10-year Treasury yield right now still below 4%, Matt Miller, a bit of about 8 basis points, bringing the yield down.
Yeah, I'm really looking forward to that Howard Marks interview because he's a distressed debt investor, right? And every time in recent memory that we talk to him, he says things aren't bad enough to buy, but I wonder if now is the time. And I think a lot of viewers are wondering the same thing. Is it time to buy? Let's talk a little bit about the economy, though. Keep it separate in some ways from the markets. Claudia Sahm joins us, chief economist at New Century Advisors. She's a former economist for the Federal Reserve. She developed, obviously, the Sahm rule that we talk about all the time, helping us to identify the beginnings of a recession. Claudia, I wonder if you're looking at a recession now because of the tariffs. And of course, we got good jobs numbers out, but the unemployment rate ticked up a little bit. How do you think economists are viewing what we're seeing happening right now from the White House?
Right. So I think this past week with the announcement of tariffs that take us up to 100-year levels of tariffs, if those go in place and stay in place for any period of time, it will be very difficult for the U.S. economy to avoid a recession. Now, we're not in a recession now, and I think, today's employment report tells us, we've got some resilience, we've got some good news on our side, but we are talking about what is essentially a major tax increase that will be hitting the U.S. economy very quickly, and that's a lot for us to buffer. So the recession concerns are more about as we go further into this year than about this moment in time.
I want to get your thoughts on stagflation, because in addition to recession, we're hearing more and more about stagflation. There was a really interesting note out from Ian Lingen over at BMO saying that it's difficult not to have a stagflation light scenario as our departure point. Claudia, what's your take?
I would agree with that. And to be clear on the term, we are likely to see inflation move up. Right. So the CPI release next week, that's probably going to be the best one we get for a while. Right. And so with the tariffs going into place, the price level will move up. We'll see inflation go up. Then there's at the same time, it's a hit. It's a tax taking away disposable income, and you're going to see growth slow. So that's the stagflationary impulse we talk about. We shouldn't think back to the 70s, double-digit unemployment, double-digit inflation. That is not what we are facing. But it's a very tricky situation where you're getting hit on both sides in terms of less growth, less employment, and more inflation. Now, I think the inflation piece, as prices adjust to the tariff, and there will be some rounds of retaliation, but that should dissipate to some extent. I think that's probably why the growth effect, this recession scare, is getting more attention. I think that's probably the right framework given the policies that we're grappling with.
Now, JP Morgan, Bruce Kasman over at JP Morgan says this basically 22% tariff is like a tax the size of which we haven't seen since 1968, worth almost 2.5% of GDP. If you raise taxes that much, Claudia, I can't understand why it wouldn't be something like we've seen in the 70s.
Well, I don't want to. We can draw lessons from past decades, but I do think it's probably worth focusing on exactly what the shock is that's coming at us. I mean, this is very serious, and again, it depends. The path forward depends so much on what these policies actually look like 6 months from now. The tariff policies, have they gone into effect? Have they been negotiated down? So there's a lot of question marks about what we're headed towards. The one thing that I would add in terms of this tax increase is tariffs create the worst kind of tax increase because they hit lower income families the hardest as a proportion of their income. So we are really going to, it's going to be a big tax increase across the board, but it's hitting those who have the hardest time buffering these kind of shortfalls in their income.
And Claudia, I just have been wondering this morning whether the genie is out of the bottle. There's this idea that's still out there that, Donald Trump is using these tariffs as negotiation tactics to basically bring other countries to the table. So far, it seems like we've mostly seen retaliatory measures from the likes of China, comes to mind just this morning, and France. But do you think that even if we did see some movement, that maybe if these tariffs didn't stay on for months, but only weeks, what would the overall hit be?
Right. Well, again, this goes back to where the starting point is very important, right? We have an economy that is still in a solid place, right? And that was affirmed today with the jobs data. So you've got a continuum of things are going to slow down some. Are they going to stagnate, or are we going to contract, right? So it does, like, the magnitude of these tariffs, and there are other policies that put in place. Also talk about the federal government downsizing and the immigration, right? Like, there's multiple anti-growth policies that the White House is pursuing, and the details matter and the magnitudes matter in terms of what it looks like. I mean, none of this is pointed in a good direction for this year, but, avoiding a recession, which once you get a dynamic going to the downside, it can really pick up momentum in the worst way. And we don't want to get in that situation, but we are certainly pointed toward this.
I will point out that Cambodia has agreed to lower tariffs. The president on Wednesday, when talking about Cambodia, said they've made so much money on us, and now they're going to lower their tariffs on some U.S. imports to 5% from 35%. So I guess that's headed in the right direction.
Cambodia came to the table.
That's right. Bank of America says it's the biggest shock to global trade in modern times. Is this really a sea change event, Claudia? Do you look at it like that?
Absolutely. I mean, this is a massive departure from the way that past administrations of the United States has approached trade, and not just for the last 10 years. I mean, we are talking generational shift in how we think about trade and whether it's a good thing for the U.S. or not. So, and this happened very quickly, right? So this is a big change. We're given very little time to adjust to it. And because of the magnitude of the change and how far off it is out of the playbook, there's a lot of uncertainty about what comes next. I mean, the thin silver lining here is this is a shock that is being driven by U.S. policymakers. We can change the policy.
Right.
Right. So, but, there's a lot of goals here, and these are elected officials. I'm not saying, but this is different than a lot of other recessions that we have faced down.
And Claudia, we don't have much time, but I do want to get your thoughts on the global economy before we go. I mean, the cliche we returned to yesterday was that the U.S. sneezes, the world catches a cold. When you think about sort of this self-inflicted economic hit that the U.S. is undertaking, what does that mean for the rest of the world?
Well, it's not good. I mean, the U.S. consumer is the powerhouse of the U.S. economy, but the U.S. consumer is also extremely important to the global economy. And so, and the fact that we have been, we're tied in this together. So this is not good for other countries. This is not good for the U.S. And then, I think the bigger question will be over the long term, where the winners and losers of this policy come from.
All right, Claudia, really great to get some time with you on this Jobs Day. That is Claudia Sahm of New Century Advisors. Meanwhile, markets continuing to sell off right now. The S&P 500 down by more than 3%. Let's take a look now with Bloomberg's Denitsa Seikova. It's pretty ugly out there.
Yeah, it's actually one of the few times we see such a clear theme across assets that really wasn't evident a few days ago. Deutsche Bank, Bruce Kassman, the theme is a global recession. And we're seeing that trade in oil. Oil has tumbled 13% in the last 3 days. We're seeing in credit spreads, insurance against defaults jumped by the most since 2023. We're seeing it in bank stocks. The index is down about 5%. We're seeing it in the VIX. It's really across asset signal that investors are worried indeed about a global recession. And earlier we had that narrative about Europe, we had narrative about US and the rest of the world, and it seems like markets are slowly pricing in really a global recession as European indices are also falling into correction and also feeling a lot of pressure. So this is no longer a US isolated damage to the market.
Are we seeing anyone, and I heard this morning on Tom Keene's Bloomberg surveillance, Danny Blanchflower saying, don't go out and try and catch falling knives. I think Bill Gross said the same thing.
Denitsa spoke to him.
Yeah, we spoke to him, and
but are you seeing anyone do that? Because to me, S&P 5200, like if you're in this market longer term, this is when you do buy.
Matt's
you want to buy when there's blood on the streets,
account open right now on your screen.
He's buying. Well, we heard that thesis. It's interesting because we spoke to a few people yesterday who was like, "Oh, this is a buying opportunity. This is the level I see," and we're already below that level. So it's a very risky. It's just like with the rally, people were like, the momentum is so strong on the upside, you don't want to short it. And now we really see that very strong momentum. Obviously, people are interested in getting those positions. The Nasdaq is down so much; it's really an appetite entry point. But it's really hard because we have that technical selling, we have the volatility target funds, the CTA, the leverage funds.
Yeah.
So
if you don't want to sell at high prices and you don't want to buy at low prices, what are you even doing in this market?
You're in cash and you're earning about 4%. I will say when it comes to levels, we keep coming back to Nick Colas from DataTrack saying that fair value on the S&P 500 is near 4,900.
4,900, he said.
Or thereabouts. 5,200 isn't that far away. But I want to talk about some of those fund complexes you mentioned because the VIX getting to 45. We actually now have volatility sort of tracking ETFs back in this market. They had a pretty ugly departure back in, I think it was 2018 with Volmageddon, but it's going to be interesting to watch some of those products.
For sure. And also, like, VIX is a very interesting metric that is featured in a lot of the models of just a massive universe of systematic sellers, of systematic investors. And what we saw, for example, in August 2nd, when we saw that massive spike in VIX, we saw a lot of those people reducing positions just because they have volatility targeting of like 10%, and obviously a massive moves changes positions for a lot of them. As you said, we have a really big buildup in that short volatility trade as well. Everyone has been so used to calm markets, everyone's used to VIX below 20, and it seems like that regime is changing. It seems like there is a lot of pressure on the VIX, so there is a whole universe of investors that are changing their positions just based on that move.
All right, Denitsa, great to speak with you. That is Bloomberg's Denitsa Seikova. Watch her byline. She is covering everything that's going on in markets. And coming up, private equity firms plunged yesterday on Wednesday's tariff announcements. We'll take a look at what's happening under the surface of private markets with Jed Laskowitz. He is head of global private markets and customized solutions over at JP Morgan Asset Management. This is Open Interest.
Let's get out of high interest to look at what's making headlines around the world. China is retaliating against President Trump's latest tariffs with a number of measures, including levies on all American goods and export controls on rare earth minerals, dealing a fresh blow to global markets. China will impose a 34% tariff on all imports from the U.S. starting next Thursday. Last hour, Trump posted on Truth Social, quote, "China played it wrong. They panicked. The one thing they cannot afford to do." Gauges for credit risk are at the highest that they've been since the banking meltdown in 2023. The moves signaling how nervous investors are about Trump's sweeping tariffs. The most active CDS contracts in the world, the market CDX North American Investment Grade Index, jumped as much as 8.5 basis points to 75.7. And Republicans for higher tax rates. Bloomberg has learned that some members of the GOP are considering creating a new tax bracket for those earning over $1 million a year with a top rate of around 40% in order to offset the costs of their tax bill. That is a stark departure from decades of GOP opposition to tax hikes. Officials in President Trump's administration allies on Capitol Hill are beginning to draft a tax package with the hopes of passing it within the next few months. Katie?
All right, let's get back to these markets because shares of the biggest private equity firms plunged in the U.S. yesterday after President Trump's tariff announcements the day before. Ares and KKR both falling the most on record. Joining us now with a closer look at what's going on in the private markets is Jed Laskowitz. He is head of global private markets and customized solutions over at JP Morgan Asset Management. Jed, it's great to see you in person.
Great to be back.
So we've seen the reaction to these tariffs in the public markets, but there's a lot of question marks over what is going on underneath the hood in the private markets. You can see that expressed in the share prices there. Give us your perspective from where you sit on what this reaction has looked like.
Yeah, I mean, we're at peak levels of uncertainty right now, or at least it feels like that. The tariffs are much more than anyone had anticipated. And as we think about, and it's kind of on one hand, we're at peak levels of uncertainty. And on the other hand, well, maybe we did get some certainty. And maybe we are going to live with these high tariff rates for a period of time. And now we have to see, well, what's on the other side of that? The Fed has a lot of room to cut rates, a lot of room to move. And I think now we're kind of waiting to see what's next. And if you look at the public market reaction, just to try to put it into perspective, if you look back at the last 45 years, the S&P 500 has had an average intra-year drop of 14%. On average, it drops 14% intra-year. In 34 out of those 45 years, the S&P ended the year positive. Now, we're at 9% right now. A globally diversified 60-40 is down less than 1% because bonds are playing a role again because rates are down and protecting with the 60-40. So I think we need to put this all in perspective, although it's been incredibly acute when you look at peak to trough. But these pullbacks are somewhat normal.
And I mean, you make a good point that there is a silver lining in 60-40 to actually have bonds doing their job. But to bring it back to the private markets, I hear what you're saying, that we've been here before, but there's a new class of investors who have come into, especially private credit, over the last couple years. It's been such a hot space. And Matt, you keep talking about, CEOs talking to their portfolio companies about not being able to move manufacturing. And I just wonder, are we headed for a potential upset when you think about some of those private credit deals that have been made?
Yeah, we're seeing a few different things in private markets, and these have been unfolding for the past few years. I think first is institutional investors in particular and high net worth clients looking for assets that offer inflation protection and low volatility. And we're seeing that in assets like infrastructure investments and real estate. And if you think about infrastructure, the need for increased energy demand, and this is not just about an AI boom, it's about the electronification of basically everything, and essential services like electricity and heat, safety and reliability being the most important. So opportunities in continuing in infrastructure. And the energy transition, as you think about that part of the infrastructure market, this is not a political issue. It's a necessity for the United States to maintain their industry, their dominance in industry. So infrastructure assets offering low volatility and real estate. Now, we're at a point in real estate where you've already seen pullbacks of 25, 30, or 40% compared to equity markets that are, still up 30% or more. And the themes we're seeing in real estate continue to be, there's a housing shortage in the U.S., industrial outdoor storage,
right.
The need for individuals want their goods fast. That's not going to change. So the themes we're seeing in real estate are continuing to persist, and these are on markets that are already down 20 or 30%.
I wonder if this isn't about your typical intra-year dip or even generational moves like AI, but once in 100-year shift in the way America operates, going from essentially a free market economy to a centrally planned economy with these kind of tariffs. I mean, it is not something that anyone is used to, and I think the concern about private markets is the opacity.
Yeah, I mean, that's true, but the private markets also offer a premium, and they offer a premium for that illiquidity, and they offer a premium for complexity. And I think, you mentioned some of the challenges, and I think there are some challenges in the private equity market. You've got 6,000 private equity sponsors across the U.S. and Europe, $3 trillion of capital, tens of thousands of portfolio companies. And if you look at last year, down rounds, later stage rounds, about 60% of later stage rounds were down rounds compared to early stage rounds where there was about 15%. That was the widest spread in a decade. So that's also why you saw continuation funds and secondaries at levels 40, 50% higher than the prior year, something like $160 billion in secondary transaction last year. So there is a shift underway. I heard you talking in the last segment about distressed. That's going to create a good opportunity in the distressed market because these companies, many of them are great companies, but they will need funding for continued operation. So, there are opportunities both in the return-seeking segment, which I would say kind of more stressed and distressed, but also in the diversifiers, real estate and infrastructure. And they should be added to that public 60-40.
Well, to your point on distress, we'll be hearing from Howard Marks in a little bit, so looking forward to that conversation. I do want to talk about access to privates. I think you probably planned for the fact that I was going to ask you about private credit ETFs. We saw the State Street Apollo ETF start trading in late February. It's been interesting to watch it during this sell-off, though. I think 70% of its portfolio is in public equities. But when you think about, again, these new buyers trying to gain exposure to private credit, what is your current thinking on whether a suitable vehicle to do that is the ETF wrapper?
Yeah, I think you bring up a great point. There are a number of vehicles that have become much more popular for private markets. Interval funds, tender offer funds, ETFs, and they present fantastic opportunities for individual investors to get access to private markets. But we have to make sure we're balancing those trade-offs of illiquidity in strategies that are daily valued like an ETF and daily traded. So I think this is much more about the intersection of public and private as opposed to private only. The majority of assets in many of these daily valued private strategies, are in public assets, and that's the way we expect the ETF industry to unfold. They'll be much more public than private, but have a dose of private assets in them to create that return kicker, for investors.
So a pure play private credit ETF, it sounds like you're saying that's either far off or maybe something that's just not going to happen.
I mean, I think right now there'd be some regulatory challenges to a 100% private credit ETF, but I do think that the opportunity set actually is much more across both that public-private spectrum. And when you get in a situation like we're in now, where you're seeing credit spreads widen, there are going to be great market-driven opportunities in public markets that you might want to take advantage of, in addition to things you might want to do on the public side. So, we think about it much more as that intersection of public-private, and that's true for equities too. There are different periods of time where you see valuations in public and private equities, and you right now you're starting to be able to get public, growth equities at much better valuations. You've been able to do that in the private markets for a long period of time.
Jed, you have a big job at JP Morgan Asset Management. What are the clients that you've spoken with the companies that you've spoken with over the last 48 hours said to you about this tariff regime change?
Yeah, I think people are trying to assess the impact. I know that sounds obvious, but I think a lot of our institutional investors have the luxury of longer time horizons, and they can take a step back and talk to us and talk to our experts about assessing the landscape. I think a number of our institutional and high net worth investors have been thinking about for some time, how do I get inflation protection in the portfolio? This idea of tariffs and being inflationary is not a new piece of information. The new piece of information is the level of tariffs. So,
right.
I talked about infrastructure at the beginning of the segment. That's an area where we see significant interest because of the inflationary protection.
Right. All right, Jed, it is great to get some time with you. I know it's been probably a very crazy week. That is Jed Laskowitz of JP Morgan Asset Management. The S&P 500 just hitting session lows, down about 3.8% at the moment. We'll continue to follow the action. All right, let's get a check on these markets because no one is stepping in to catch this knife right now. The S&P 500 down by about 4% for the week. The S&P 500 has lost about 7%, on track for the worst weekly performance since March 2020. Not a superlative you want to see, and similar ones exist for the NASDAQ 100 and your big tech stocks, down about 4% at the moment. That bid into the bond market has been reignited in the past couple minutes. The 10-year Treasury yield now down 13 basis points points. We're staring at 390 on your benchmark 10-year yield. Let's bring this conversation into the ETF world, because leveraged ETFs have tens of billions of dollars of U.S. equity exposure to dispose of. That's according to JP Morgan. The bank estimates that those products have to sell about $5 billion every time the market declines 1% just in order to rebalance. Joining us now for a closer look, I'm pleased to say we have Bloomberg Intelligence ETF analyst Eric Balchunas. And Eric, I know you disagree with that estimate. Tell us why.
Yeah, because it doesn't take into account flows. And what you're seeing here is that, believe it or not, there's flows going into these leverage long ETFs. So that blunts a little of that. And the selling isn't really from the ETFs themselves as much as the hedging. So when you do a swap, these ETFs run on swaps. So the swap counterparty would have to short the stocks in order to keep neutral, right? So I do agree, though, that in general, if you look at the long-only ETFs, they're the bulk of the assets, but there's these funky leveraged in buffer products that sort of use options, and all of that creates like an amplification effect.
Right.
It's not that big compared to the size of the market, but it certainly is out there. And so, yeah, if the market goes down, these amplified kind of options using ETFs and swap using ETFs are going to add a little bit of downward pressure as well.
Right. Well, let's talk about that a little bit more, because you think about triple leverage Qs, those ETFs have been around for a while, but some of the categories that you mentioned, especially leveraged single stock ETFs, this is the first real dramatic market test that these products have been put to. And I don't want to get too dramatic, but could we see some sort of blow up, some sort of accident happen with some of these really out there products?
Yeah, no, we always talk about how these products are susceptible to what we call a hard rain. And this is a pretty hard rain developing. And in 2020, many of them got washed out. 2022, a bunch of other ones got washed out. So far, so good, though. Like, if you look at yesterday, the worst one was down 32%. Now, I know that sounds bad, but I would want to see one over 50 before we put it on the radar. So I think we'd have to see like a 7% sort of limit down day probably to get anywhere near this. But if the compounding effect kicks in, some of these could go to like negative 90% very quickly or over. So that said, that is what attracts some of these degen retail traders to the area, because for every down 32% one, there's a mirror twin that's up 32%. So we're seeing elevated volume in this area as the traders try to play it both ways. They love this environment. But yeah, we could see a blow up.
Retail investors, I know, are asking themselves, do I buy this dip? Because I get so much email from viewers expressing that exact.
You're also asking that question.
Well, I mean, I'm asking it because so many people are writing in and saying, like, okay, there's blood on the streets, and this is when we're supposed to buy, right? Benjamin Graham. So do you see that in ETFs, Eric?
Absolutely. This is something that I always talk about. And I actually got a text from my college roommate yesterday. He says, what's the buzz at Bloomberg about tariffs? I'm sticking with my steady monthly investments into my Vanguard ETFs. So I taught him well, by the way. This is probably the text people are going to get if you're in this industry. We find that a lot of Vanguardian type investors, at some point in their lives, they just came to the conclusion that they cannot time the market. And if you feel like you cannot time the market and you are totally resigned to that fact, the only answer is to just keep dollar cost averaging into the market. So most of the Vanguardian crowd is doing just that. And There was an article on Bloomberg today. They're buying the VU, the Schwab ETFs. We call those the buy and holders. The trading crowd, though, a little spooked. SPY saw some outflows. So there's this sort of bifurcated, the traders getting a little spooked, but the Vanguardian bid still looks pretty solid. And it looks solid through most of 2022. It looks solid through 2020. And Vanguard, believe it or not, took in money every month in 2008. So it will take a lot more, I think, before you shake them.
Yeah, it's just wild. You mentioned VU. That, of course, tracks the S&P 500. I look at what the leaderboard looks like for flows over the past week, though. I also see, in addition to some of those S&P 500 passive index tracking funds, I also see BIL. I see SGov. Those are very short-dated Treasury securities ETFs. So it seems like, in addition to just buying into the dip that we're seeing in the indexes, Eric, that also there's this still gravitation towards cash.
This is a great point and really important. What we find in these types of sell-offs is the Vanguardian crowd will continue to buy dips, and even some of the traders will. But a lot of times they want to buy some protection while they're at it. So we do see gold and cash-like ETFs punching way above their weight in flows this year. So they're buying protection as they buy the dip, which again, you could argue is a sign of their nerves.
All right, Eric, great stuff as always. That is Eric Balchunas. Tune into ETF IQ every Monday at 12 p.m. Eastern. Me and Eric and Scarlet Fu talk about the ETF world. You can also read all about the ETF industry in my weekly newsletter. That is Bloomberg.com/ETF IQ newsletter.
That's not Cats and Coins?
No, it's official now. But Eric was talking about dips to buy, and boy, do we have one in the NASDAQ 100, Matt Miller.
Yeah, I'm looking right now at the NASDAQ 100 from its highs at the end of the year, currently down 21.6. Sorry, I'm looking at the broader, the CCMP, down 21.66%. That's got 3,000 stocks in it. If you look at the NASDAQ 100, you're likely to see pretty much the same thing as the two track each other very closely. All I do is click into the chart and then annotate it. Right now, I'm looking at a drop of the NASDAQ 100, 20.1%.
Just amazing. You think about the biggest losers, NVIDIA, Apple, Broadcom right now, taking that index into a bear market, and coming up, markets continue to plummet as the tariff turmoil continues. We'll hear from Oaktree Capital co-chairman Howard Marks next. This is Open Interest on Bloomberg.
Welcome to our TV and radio audience worldwide. Let's get to Bloomberg's Lisa Abramowitz. She's sitting down with Howard Marks.
Thank you so much to our Bloomberg radio and TV audience. We are incredibly lucky right now to get a chance with a man on the 30th anniversary of the firm he co-founded, Oaktree Capital Management, which has since grown into the world's biggest distressed debt investor. Mark's joined us on a day of turmoil after putting out a memo about a month ago where he wrote, "The bottom line is that credit presently offers a better deal than equities. Even at today's spreads, credit isn't a giveaway today, but it offers a healthy absolute returns and is fairly priced." Howard joins us right now. Howard, you wrote that a month ago. The world has changed. We have seen the market sell off. We have seen tariffs implemented that are the highest levels that we've seen going back 100 years. Does your thesis still hold?
The yields on credit are still very healthy. And in fact, credit yields a little more now than it did 6 weeks ago when I wrote that memo. Then high yield bonds, for example, were yielding around 7.2. Today, they're close to 8, which means they went down in price, producing a higher prospective return. Of course, the stock market is well down since then. I don't know, 15, 16, 17%. I haven't done the math yet, and it keeps moving. But, you know, obviously, the state of the world, which equity prices depend on, is completely in flux and has been radically changed. Most investors think for the worse. That's why prices are down. The question, of course, is whether they're down too much, just right, or not enough. And almost nobody can say.
How do you start to even measure something like a potential paradigm shift, like the tariffs that were announced earlier this week?
Well, first of all, of course, measure is the wrong word because that suggests some quantification, which is impossible. There's nothing to measure. But how do you gauge? How do you think about the changes? And, you know, this is the biggest change in the environment that I've seen probably in my career. You know, we've gone from free trade or world trade and globalization to this system which implies significant restrictions on trade in every direction and a step toward isolation for the United States. I believe that the last 80 years since World War II have been the best economic period in the history of mankind. And one of the major reasons was the growth of trade. And I think that we have truly had a rising tide that lifted all boats, and trade was a big part of that. And everybody in the audience should understand the role of trade. Every country, for example, does some things better and worse. And worldwide welfare is maximized when every country does the things it does best and cheapest, and then sells them to the countries that need them, which do other things and sell them to other people. That's how trade works. And, well, I don't know if it's politically correct, but the good news is that the Italians make the pasta and the Swiss make the watches. But if we stop world trade and the Swiss have to make their own pasta and the Italians have to make their own watches, the world will probably be, well, maybe arguably people in both countries will be a little worse off. That's what we're talking about here. And we should not underestimate the benefits that we've gotten from globalization. And among other things, there was a 25-year period, which I cited in one of my memos 10 years ago, in which the cost of durables in the U.S. went down by 40% in inflation-adjusted terms. That kept a lid on inflation here. It made goods available cheaply to all Americans. If we don't have world trade, we don't have that benefit. And, you know, the tariffs are designed to encourage production at home. But who could imagine that most things produced in the United States will be as cheap as they are coming from abroad? In other words, things will cost more.
If that's the case, does that mean that you see the inflationary regime as being something that is more persistent, or a reversal of what we saw, the disinflation of the globalization?
Well, I think so. There were financial benefits from globalization, including keeping a lid on inflation. And, you know, if we hadn't bought our TV sets and appliances from abroad in that 25-year period at declining prices, what would inflation have been? And the answer is considerably more. Maybe not 2, but maybe 3, 4, 5. And so, tariffs are an increased cost. Somebody has to pay them. And, most people think the consumer will pay them. There's some possibility that the importer or the exporter will pay them, or the government of the exporting country. But it's an increased cost, the proceeds from which will go to the government. And, will society be better off as a result?
When you're measuring how to decide the risk and reward of given asset classes in this type of environment, that could go in a multitude of different ways. How do you understand where there's value, what a return is that would justify a risk at a time when, potentially you could get 7, 8%, 9% with credit? With stocks, they have delivered more than 10% for the past number of decades. But going forward?
I want to respond first to your last sentence. Stocks have delivered an average of 10% a year for the last 100 years, but not when the PE ratio was 19. And the PE ratio today is probably 19. The average return has been 16. So we can say that when the PE ratio averages 16, the return average is 10. But when the PE ratio is 19, my guess is, if you look at history, if you bought the S&P when the PE ratio was 19, historically you probably made, let's say, 1 to 6% a year, or 2 to 7% a year, something like that, but certainly not 10. And so, what you pay matters, and the price of the S&P is elevated relative to historic levels, so you shouldn't expect historic returns.
Whereas in credit, one of your arguments is you can expect to get that return because the default risk isn't as great as some of the excess spreads and what you're getting in all-in yields.
Well, with credit is a newfangled word for fixed income, which was a newfangled word for bonds. In 1978, I was moved at Citibank from the equities department to the bond department. Nobody talked about fixed income or credit. But with debt, or bonds, or fixed income, or credit, what you see is what you get. You can read on the piece of paper what the promised return is, and then the only thing you have to wonder about is, will I get it? That is to say, will the issuer default, or will they keep their promises? And by the way, they promise you interest, they promise you to pay your money back at the end, and if they don't keep the promise, they lose the company. So they have a lot of incentives to pay. I've been in non-investment grade credit for 47 years, and in our experience, roughly 99% of our issuers have paid as promised.
You've thrived during your 5-decade career, almost 5-decade career, during times of dislocation. Is this a time of dislocation to play or not to?
Well, it's a time of dislocation. Everybody has to judge for themselves whether the reduction in asset prices so far is right, inadequate, or excessive. If it's excessive, you should jump in with both feet. If it's inadequate, you should wait until things adjust further. And it's impossible to make that judgment qualitatively. You used the word measure before. I pushed back a little bit. There's no place you can look. There's no analysis you can do to determine whether today's asset prices are right for the environment ahead. Now, there never is. It's always conjecture. It's always guesswork. That's, in theory, why the greatest investors are great, because they make those judgments better than most people. It's excessively hard today because today we have no idea what the future is going to be. Normally, we think we know what's going to happen in the future. We normally assume the future will look mostly like the past. We extrapolate, and usually it works because the world doesn't change that much. But the the world economy and the world order beyond economy, meaning geopolitics and international relationships, has been shook up like a snow globe by the events of the last days, and nobody knows what it's going to look like. Nobody knows. I dare say, if you tell me that what our rules will be 6 months from now, I'll bet you're wrong. This is in flux. And if you think it's in flux, then by definition, you don't know what the future holds. And then even if you know what our country's going to do, and it's going to be that way 6 months from now, we don't know what other countries are going to do, what the ramifications will be. And so, I always inveigh against forecasting. I don't believe in macro forecasting, my own or other people's. And we know much less today than usual. Now, people who like to run their lives according to forecasts, they say, well, this is going to happen in the future, so I'm going to do this, and this is going to happen in the future, so I'm going to do that. What you really need, if you like to work with forecasts, is you need two things. Not just a forecast. You need the forecast, but you need an estimate of the probability that your forecast is correct. And today, whatever your forecast may be, you have to say, the probability that I'm right is lower than ever, because the probability that we know what the future is going to look like is lower than ever. And that's how I feel.
Is this a time to be fearful or greedy?
What you have to say, Bloomberg's offices, you have to think in terms of your neighbor. The department store. Bloomingdale's. Bloomingdale's just put everything on sale. Prices have come down for the S&P 8% in the last 2 days, and much more in the last 6 weeks. It's on sale. That should encourage people to think about buying. Will they go down further? Nobody knows. Are the prices fair? Nobody knows. But everybody runs from the market when prices go down because they think it connotes risk. It's just stuff going on sale. And, of course, it takes, well, I was going to say a pro, but it takes a prescient pro, of which there aren't many, to know whether, as I keep saying, the discounts are adequate or appropriate. But certainly you have to look, and it doesn't make any sense to say, just a minute, I did X, Y, Z when the price was 100. Today the price is 90, so I'm going to boycott it. That doesn't make any sense on its face. You have to take a hard look.
Do you still think that the U.S. is the best place to invest?
I think it's probably still the best place, but it's less best than it used to be, because I think that, if you think about the things that made it the best place, one of them was the rule of law. That may be less the fact today. One of them was the predictability of outcomes. That may be less today. One of them was the worst thing about investing in the United States for many years has been our fiscal situation, our deficits and debts. And the U.S. has behaved like somebody who has a golden credit card where there's no credit limit and the bill never comes. So, of course, you can spend more than you make. And if somebody has a golden credit card, well, what would you do? Well, you might buy a nice car, but what the hell? You might as well buy all the cars because the bill's not going to come. And that's the way we've behaved. And that's the way Washington has spent money. But can the events of the recent days change that? Can they cause there to be a credit limit? Can they cause a bill to be presented at some point in time? And if the answer to either or both of those questions is yes, that's a real risk. If people don't like the dollar, don't like investing in the United States, don't want to hold an unlimited number of treasuries. If we just make people mad and say the U.S. is still a great credit, but I don't want to hold their debts because look how they're treating me, the fiscal situation will be very complicated.
Howard Marks, we have to leave it there. That was Oaktree Capital co-chairman Howard Marks. Thank you so much. Back to you.
All right, and our thanks, of course, to Lisa Abramowitz and Howard Marks of Oaktree Capital. While they were speaking, we watched losses continue on the S&P 500, at one point falling 5.2% in a single day on the S&P 500. Just a refresher, it's been a while. Circuit breakers kick in at a drawdown, an intraday drawdown of 7%. Then the market will be halted for at least 15 minutes. The last time we saw these level 1 triggers go into effect was March 18th, 2020. That is according to Barron's. So we're still a ways off there, but something to keep in mind. And Matt Miller, I just want to point to volume right now. Trading volume is off the charts. We are 110% above our 30-day average on the S&P 500. So traders really selling aggressively into the weekend.
Absolutely. And you see the VIX creeping back up over 40 right now at 42.55, as you saw there from bonds. Buying is in action there. So price up, yield down to the 10-year at 3.90. Stay with Bloomberg. About 30 minutes until Fed Chair Jerome Powell delivers a keynote. This is Bloomberg.
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York, I'm Caroline Hyde, and this is Bloomberg Technology. Tariffs, they hit global tech stocks again today as China retaliates and imposes tariffs on all American imports and withholds crucial rare earths. $2 trillion wiped off the Nasdaq 100 in 2 days alone. That's as the benchmark is set to enter a bear market. Investors now expecting the Federal Reserve to cut interest rates 4 times this year. We will hear from the Fed Chair Jerome Powell later this hour. But we've got to dive into the Nasdaq 100's move. Ron Blestelka is here. Extraordinary. We haven't seen this sort of sell-off since 2020.
Absolutely. The scale of the weakness has been pretty, breathtaking. The size of the drops, just the broad-based nature of the sell-off. It's been pretty remarkable.
What's also remarkable is how much we start to see the ongoing retaliation, whether it be from countries such as China and the impact that will have on being able to make technology products here in the United States, but individual companies later will be shining a light on Nintendo reports that they're going to be delaying their switch to pre-orders to the US. All of this, is it yet priced in, Ryan? What are analysts telling you?
Well, what I've heard so far is that there's just so much uncertainty out there that few people are really willing to jump in right now. I mean, some people remain positive on a longer term basis. They say if you have a 3 to 5 year time horizon, maybe you can take advantage of some of the drops in some of these names, but we don't really know what to expect. I mean, yesterday things were really bad. They're even worse today. We had China retaliate. Is there going to be a response to that? Some kind of back and forth? We just don't know, and that makes it extremely difficult for companies to know how to plan, and that makes it extremely difficult for investors to know how to position.
And at the moment, just where in particular are the pain most acute? It's hardware rather than software, but software still in the eye of the storm if indeed the EU decides to respond from a digital services tax perspective.
Yeah, absolutely. So far, we saw a little bit of relative outperformance in software, especially yesterday. Some people were telling me maybe this is too much, too fast for software because they're not as directly exposed to tariffs as other part of the market. But certainly hardware, like you mentioned, very much getting hit with this. It's extremely, there's a lot of manufacturing exposure to China, to Vietnam, to places that really got hit with tariffs. Those places really suffering, over the past couple of days in particular. Chips have really come in quite a bit. There's still, like I said, a lot of uncertainty. People were already concerned about what is the outlook for AI spending. People were already talking about valuations maybe being elevated. All of these things are just dovetailing, and it's just you have a lot of reasons to be selling right now and very few reasons to be buying.
Worst case scenario is the lead quote in your story coming from a particular investment, the CIO of Granite Bay Wealth Management. Do we think there's a movement back from this worst case scenario? There have been many calling for the fact that Apple might get some sort of exclusion from the tariffs longer term. Are many bracing for just headline risks going forward?
I think there's a lot of bracing for headline risk. There's been a lot of hope that Apple would get an exemption the way it did in the first Trump administration, but this is a very different kind of trade war, very different tariff policies than we saw in the first administration. So there's not really much of a playbook that you can use here in the same way, you might have thought, well, it wasn't that bad, 8 years ago or whatever that was. It's looking like a lot more severe right now. And that, again, just makes it harder for people to know how to allocate, how to position, if they should be bracing for more short-term pain, if this looks like a long-term buying opportunity. There's just so many questions right now. It's hard to know really what to do. That's what people are telling me.
Get back to the phones, I'm sure, and the email. Ryan Blestelka, thank you so much for spending time with us. Look, let's turn to individual stocks. Tesla, for example, trading lower, unsurprisingly. In fact, it's down 15% in the last 2 days following tariff news, its own deliveries miss. Interestingly, JP Morgan want to shine a light on their perspective. They've cut their estimates further on the stock, quoting what they see as unprecedented brand damage. Bloomberg's Craig Trudell joins us for more. And we'd been deciding whether this was production issues, whether this was the lack of a new model. But for JP Morgan, this is brand damage.
Yeah, and I do think it's both, right? But of course, JP Morgan, as one of the more bearish analysts or bearish brokers on the street, they have very much sort of leaned into this idea that this is more than just the Model Y changeover, which, we should note is a significant issue in the first quarter. And it remains to be seen just how much, Tesla can sort of overcome any brand damage that is an issue here. But it is, hard
hard to sort of think of an equivalent moment for a car brand where you see people, throwing paint onto showrooms and lighting cars on fire. This is just, very unusual for any product, but particularly for cars where, this is the second most valuable thing that people buy right after their home. So, to buy a Tesla now means something a lot different than it did, only months ago. And, there are real questions about just how much sort of lasting impact Musk's, entry into politics is going to have on this brand.
You cite, of course, JP Morgan being one of the more bearish on the street, and they've got a price target of just 120. But you go to the more optimistic, the bullish on the street, Dan Ives of Wedbush, $550 price target on Tesla. Even he is saying the recent report, the deliveries one, a disaster on every metric. Is there any view that Elon Musk potentially starting to ease out of the White House and his day-to-day roles, as has been reported? Of course, they push back against that. But whether or not he will come back to the fold, refocus on Tesla, and that being an optimistic light?
I think if we listen to what Musk is saying and what even J.D. Vance has said, I just have a hard time sort of seeing Elon sort of heading to the back seat, if you will. That's not very much his nature, right? He has very much sort of gotten in deep with this administration. Just in the last few days, he was pictured with a Trump, everything Trump said was right hat. I may be getting the verbiage a little off, but he is very much behind the president and sort of one and the same with this administration. And even if he does take a step back officially, I think it's hard to sort of fathom how he could really sort of separate himself after he's thrown himself in so emphatically the last 6 months.
Craig Trudell, who's been following this for 6 months and then some, we thank you. Look, the market onslaught, it continues for other names. Let's look at Apple. Their market cap slipping now below $3 trillion. Let's get to a key analyst on the stock, Apple. Gil Luria, D.A. Davidson, Managing Director, joining us now. You look at so many names, and I'm excited to talk to you about all of them, Gil. But let's just focus in on Apple at the moment and what extent is being priced in the supply chain upending and indeed the tariff impact. Will they get some sort of exclusion, do you think?
It looks less likely now that they'll get an exclusion than last time. I think that commentary is probably correct. The market is doing its best to assess the impact on Apple. Right now it's just doing the rough math. A third of the revenue being impacted, about a third tariffs higher. One times another, the stock is down about 10 to 15%. That's as good as the market can do right now. We're going to have a few days and weeks to refine that math as we see how this plays out. But the structural change to the United States' role in the global economy has already happened now. And every day and week that we proceed in this direction, it's going to be cemented as a different world order. And therefore, we have to get better at doing the math about how that impacts companies like Apple, but also a lot of other technology and other companies.
There are so many headlines coming out minute by minute, Gil, and one of them, we understand President Trump is saying that Vietnam wants to cut their tariffs down to zero. Now, Vietnam has become a relatively new hub for Apple. How are they able to, in this moment where the news can change from day to day, able to stomach the higher costs? Because they have a healthy margin of about 46 to 49%.
That's right. So Apple has a few levers. One, it can push cost increases to its suppliers. Two, it can pass through price increases to its consumers. And then three, it can absorb some of the margin degradation. So it has all three levers. In the short term, it's going to use all of those. But to your point, in the medium to long term, it has the ability to shift production. It's already started shifting production from China to India and Vietnam, who are far likely to arrive at a beneficial agreement with the United States about tariffs and trade than China is. Yeah. So the fact that Apple's already manufacturing in India and Vietnam gives them medium term and definitely longer term flexibility to offset some of the tariff increases and reduce the impact on prices and margins.
Gil, that's the hardware perspective, and I can understand why in NVIDIA that you also look at is feeling the pain on a hardware perspective and getting product out of Asia. Meta, under significant pressure, why? Is that more about the EU response mechanism?
That's part of it. Part of it is that in an economic recession, there's less advertising dollars, which will mean less digital advertising, which is really all of Meta's business. So that's part of the reaction. Part of the reaction is Europeans have a habit of drawing funds out of our large technology companies through non-tariff barriers. So they'll decide that Meta isn't doing a good enough job on privacy, so they'll limit Meta, they'll fine them billions of dollars. They've done the same to Google, they've done the same to Apple. And so the more we get in conflict with Europe, that's a lot of the lever that the Europeans have.
Right.
It's not just tariffs on goods, it's the Europeans' inclination to put in regulation that restricts these companies and allows the Europeans to fine them billions of dollars.
Talking of levers, President Trump thinks he's got a lever when it comes to TikTok and China tariffs. Just, you cover Oracle. In any capacity, do you want to see Oracle become a minority holder of future shares in a US TikTok, if indeed that deal that seems to be being discussed with the White House goes through?
Somebody's going to get a windfall from this. The TikTok US business is incredibly valuable. And to the extent we can accomplish the national security goal of not allowing our data to be sent to the Communist Party in China, that business is incredibly valuable. And whoever gets to participate in it is going to get a windfall. It looks like Oracle may be in the running to do that, but everybody else is running for that too. It's incredibly valuable because if you think about it, there's only really 3 venues for social media where you can access consumers: Google's YouTube, Meta's properties, and ByteDance's TikTok. And whoever owns TikTok in the US will have a very valuable asset. And to extent Oracle can expand its business, it already has a TikTok business in hosting. Yeah. If it can expand more into an operations role with TikTok, that would be a windfall to Oracle.
There's got to be some people winning in certain circumstances. Gil Luria of D.A. Davidson, we thank you for your real expertise. Let's just go to more breaking headlines right now, because President Trump is indeed speaking. We understand that he says it's perfect time for Chair of the Fed, Powell, to cut interest rates. Remember, we're hearing from Fed Chairman in but 10, 15 minutes time. He is speaking at an event in Arlington, Virginia, among other journalists. And we understand that Trump is saying that Powell is always late, but this is the perfect time for Powell to cut interest rates. The market currently factors in 4 interest rates cuts for this year. Let's take a look at some other companies that are being moved around via tariffs. Nintendo, for example, check in on its US ADRs. The stock, as you see, falling, currently 3.3% intraday. There are reports out there that the company is set to delay its US pre-orders of the Nintendo Switch 2 because of tariffs. The product launch date is still set to remain on June 5th. Coming up, Vice President J.D. Vance says a deal for TikTok will come out before the deadline for its potential ban. That deadline is tomorrow. We'll discuss that next. This is Bloomberg Technology. Breaking news in response to the market turmoil. News on Klarna. The company is said to be delaying its planned IPO after the implementation of Trump's tariffs. That's all according to the Wall Street Journal. We'll bring you any more breaking news on Klarna and its planned IPO, but as we understand from the Wall Street Journal, it's pausing its plan for initial public offering. Meanwhile, Saturday is the deadline for ByteDance to find a buyer for its US TikTok holding or be banned. President Trump and Vice President J.D. Vance have both signaled that a deal is within reach. Bloomberg's Kurt Wagner joins us for more. And maybe a deal even before Saturday the 5th?
I would be surprised if we don't have something before Saturday. It's either going to be an announcement of a deal or a proposed deal, I should say, because, again, this requires buy-in from the Chinese government and ByteDance, which I don't believe we have yet, or an extension to continue discussing a deal, right? But we know that this week the Trump administration was meeting to talk about a specific deal that involves Oracle, Blackstone, and a handful of other investors. I think we're really circling around something that looks like that, and I expect we'll have something before midnight Eastern tonight, which, as you pointed out, is when this ban is supposed to kick in if they don't do something.
The deal is all very well and good depending on who's agreed on it. And I suppose that the US investors might be aligned, but do we understand if ByteDance and the Chinese government might be aligned, considering they've just unveiled further tariffs in response to the US ones?
Yeah, that timing is not necessarily a strong sign that everyone is working together here. We have not heard from ByteDance. We have not heard from the Chinese government. My, understanding is that the U.S. side of this equation is working to propose something that then they hope will be accepted on the other side of the fence there. But as you point out, we're in the middle of this global trade war right now, particularly with China. And so Trump has suggested, well, hey, maybe the tariffs come into, are a negotiating bargaining chip in this whole thing, but it is a complicated situation because of what you just mentioned.
And what's also complicated is what happens to the algorithm and what oversight Oracle and indeed US investors ultimately have, and whether that's in line with the letter of the law. 2024 law passed, didn't have much way in which the algorithm could be kept in Chinese hands.
That's right. So by letter of the law, the Chinese tech company ByteDance or the Chinese government should have essentially zero influence or control over this algorithm. The deal that has been proposed seems to suggest that they would. And so the deal that is being discussed may not follow the law. Now, the question is there someone who's going to challenge President Trump on that, right? If he just simply says, this is acceptable to me, we're going to do it, is Congress going to step in and say, hey, look, this doesn't follow the law, we're going to challenge you, or are they going to let it slide? And I don't know the answer to that. But I think you bring up the stickiest point in this whole thing, which is the actual control over this key technology. Both sides want it, and I'm not sure how they're going to rectify that.
Bloomberg's Kurt Wagner, staying on top of a very timely conversation. We thank you. Let's focus now in on what advertisers, marketers do in this moment. Do they go to TikTok or not? Rachel Tipograph is with us, founder and CEO of MikMag. You have the data. And since January 19th, which was the first deadline when we were worried it was going to be banned and it went black for a moment, traffic has recovered to TikTok, right?
Absolutely. So January 19th, I was here with you. We saw TikTok traffic go to zero. It took about until March 1st for TikTok traffic from major advertisers to reach Q4 levels. Why? There was a lot of confusion if it was still legal to advertise on TikTok. And if you've been following, TikTok did a lot of advertising themselves to communicate this is a safe place for you to advertise. Here we are, and we're now seeing TikTok traffic surpass Q4 levels. So MikMag tracks 2,300 of the biggest brands in the world, and our traffic on TikTok right now is 20% higher than Q4 levels.
That's pretty phenomenal considering the level of uncertainty going into this Saturday. Is there likelihood that people are paring back just into this one-off event?
We haven't seen that yet. And the reality is TikTok is a very unique asset. It's why we have the US and China fighting over it. You can build brand and drive conversion all at once. So until US advertisers hear that they shouldn't be advertising on that platform, I believe that they will continue to do so. That being said, they all have contingency plans. They have contingency plans for tariffs, and now they have contingency plans for advertising. And what we saw around January 19th is how easy it is to move dollars from one platform to another.
Where did it go? Where did it shift? Who benefited?
So the two big beneficiaries were Alphabet. So Alphabet is paid search, YouTube, DV360, and Pinterest. In both of those platforms, you can drive conversion and brands consider it a brand safe environment.
Is that why they're not going to Meta? Why did Instagram not become the automatic place you put yet more advertising dollars, or is everyone already there?
So the interesting thing about Meta is it is the gorilla. It's the giant. On any given day at McMack, it's our #1 source of traffic, and it remains to be so. That being said, when we compare Q1 to Q4 Meta traffic, we've seen a 3% decline. And when we look at the timing of this, it's all around Zuckerberg's announcement of removing fact-checking from the platform. So it goes back to many of the things that brands are balancing right now, and one of them is concerns around brand safety.
That's really interesting. And I'm wondering, therefore, also at this moment, we're seeing Meta stock under pressure significantly because people are worried that advertisers are going to pare back because of economic uncertainty, let alone brand certainty and safety. Is that something you're preparing yourself for?
Absolutely. I mean, this is a whole other curveball. This isn't about TikTok or Meta or the Trade Desk. This is about tariffs and consumer goods. And the reality is, consumer good companies are in a really tough spot. Their margins are getting squeezed, and they really only have 3 options. Raise prices, which retailers and consumers don't want that. The second is reduce supply chain, so essentially produce fewer SKUs. I can tell you advertisers are not going to want that. Why? What creates advertising revenue to rise? Auction density. You need more SKUs. And then finally, the worst thing, which is what I think the markets are reacting to, is removing working media spend altogether. And I can tell you, if you're a student of brand the way that I am, if you stop investing in brand, you will lose market share.
Right.
And every CMO and CFO across the world right now is having this conversation.
Worried about tariffs. Going back to TikTok, though, in 30 seconds, if TikTok isn't bought by the Oracle contingent and we don't see the algorithm come to US hands, do people stick with it?
I think that you're going to start to see dollars shift very quickly then, and they'll shift into platforms like Alphabet and Pinterest.
Always great having McMack's data. Rachel Tipograph, a joy to have you on. Thank you. Look, we've got more breaking news in response to the tariffs. This one is StubHub's IPO. We understand, according to the Wall Street Journal, that StubHub has also delayed its plans for initial public offering. Remember, there's the likes of StubHub who are in potentially coming to the market. We also have Klarna delaying, according to the Wall Street Journal, the ripple effects being felt far and wide. Coming up, we're going to be hearing from the Fed Chair Jerome Powell in the midst of this market uncertainty following widespread tariffs, reaction from China. That's next, and this is Bloomberg Technology. US jobs growth actually beat forecasts in March, pointing to a healthy labor market. This, of course, before the global economy gets hit by widespread tariffs. Bloomberg's Mike McKee is here to break down what looks resilient before, of course, this wall of worry.
Well, actually, the labor market is good news, but we now have the headlines breaking from Jay Powell's speech in Washington, and he is saying that the effects of the tariffs are probably going to be stronger than people anticipated, than the Fed anticipated. Inflation may be higher, and unemployment may be higher. The economy may grow more slowly. The size of the effects is going to be uncertain, and he says while tariffs are highly likely to generate at least a temporary rise in inflation, it's also possible that the effects could be more persistent. So he's dropping the word transitory here. So Powell is making it also clear that the Fed's first goal will be to fight inflation, saying their obligation is to keep longer-term inflation expectations well anchored and to make sure that a one-time increase in the price level does not become an ongoing inflation problem. They're well positioned for whatever happens, but he says it's going to take time to be able to figure out exactly what the impacts are going to be.
There is the bind. Inflationary pressure, but trying to stabilize an economy, and the market already pricing in 4 rate cuts. Does that get pulled back when they start to see his voice about inflation?
It may, yes. So we may see that move. It'll be interesting to see what the overall markets do given where they are, because he's basically saying if the economy slows, we're going to let it for the time being. We're going to keep an eye on inflation, and we think inflation could be worse than we had forecast because the tariffs are higher than we had thought.
What's interesting is President Trump himself has been talking about Jay Powell, saying he's always late, but this would be a good moment to cut interest rates. We know where the White House position is on all of this.
And the Fed chairman is saying, no, you're absolutely wrong. And our first move might be to raise rates if we have to fight inflation. I think that Jay Powell's just starting here, so turn it over to him.
Congress has given us of maximum employment and stable prices. While uncertainty is high and downside risks have risen, the economy is still in a good place. The incoming data show solid growth, a labor market in balance, and inflation running much closer to, but still above, our 2% objective. After a couple of years of solid growth, many forecasters have anticipated somewhat slower growth this year. The initial reading for first quarter GDP will be released later this month. The limited hard data are consistent, though, with a slower but still solid growth outlook. At the same time, surveys of households and businesses report dimming expectations and higher uncertainty about the outlook. Survey respondents point to the effects of the new federal policies, especially related to trade. We are closely watching this tension between the hard and the soft data. As the new policies and their likely economic effects become clearer, we will have a better sense of their implications for the economy and for monetary policy. Looking across many indicators, the labor market appears to be broadly in balance and not a significant source of inflationary pressure. This morning's jobs report showed the unemployment rate at 4.2% in March, still in the low range where it has held since early last year. Over the first quarter, payrolls grew by an average of 150,000 jobs per month. The combination of low layoffs, moderating job growth, and slowing labor force growth has kept the unemployment rate broadly stable. Turning to the other leg of our dual mandate, inflation has declined sharply from its pandemic highs of mid-2022. It has done so without the kind of painful rise in unemployment that has often accompanied periods of tight monetary policy that are needed to reduce inflation. More recently, progress toward our 2% inflation objective has slowed. Total PCE prices rose 2.5% over the 12 months ending in February. Core PCE prices, which exclude the volatile food and energy categories, rose 2.8%. Looking ahead, higher tariffs will be working their way through our economy and are likely to raise inflation in coming quarters. Reflecting this, both survey and market-based measures of near-term inflation expectations have moved up. By most measures, longer-term inflation expectations, those beyond just the next few years, remain well anchored and consistent with our 2% inflation goal. We remain committed to returning inflation sustainably to our 2% objective. Turning to monetary policy, we face a highly uncertain outlook with elevated risks of both higher unemployment and higher inflation. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. Our monetary policy stance is well positioned to deal with the risks and uncertainties we face as we gain a better understanding of the policy changes and their likely effects on the economy. It is not our role to comment on those policies. Rather, we make an assessment of their likely effects, observe the behavior of the economy, and set monetary policy in a way that best achieves our dual mandate goals. We have stressed that it will be very difficult to assess the likely economic effects of higher tariffs until there is greater certainty about the details, such as what will be tariffed, at what level, and for what duration, and the extent of any retaliation from our trading partners. While uncertainty remains elevated, it is now becoming clear that tariff increases will be significantly larger than expected. And the same is likely to be true of the economic effects, which will include higher inflation and slower growth. The size and duration of these effects remains uncertain. While tariffs are highly likely to generate at least a temporary rise in inflation, it's also possible that the effects could be more persistent. Avoiding that outcome would depend on keeping longer-term inflation expectations well anchored, on the size of the effects, and on how long it takes for them to pass through fully to prices. Our obligation is to keep longer-term inflation expectations well anchored and to make certain that a one-time increase in the price level does not become an ongoing inflation problem. We'll continue to carefully monitor the incoming data, the evolving outlook, and the balance of risks. We're well positioned to wait for greater clarity before considering any adjustments to our policy stance. It is too soon to say what will be the appropriate path for monetary policy. We understand the benefits of a solid economy where workers can find jobs and inflation is low and predictable. We also understand that elevated levels of unemployment or inflation can be damaging and painful for communities, families, and businesses. That is why we at the Fed will continue to do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you for being here. This feels like quite a moment to be speaking with you, and I want to thank you for your time. He's got it. I want to thank you for being here, and thank you for taking the time to speak with this group of business journalists. Also like to give a special thanks to Heather Long with the Washington Post, who helped make this event possible. So for starters, sir, how's your week been?
Just fine, thank you.
Care to elaborate?
So far, so good.
Chair Powell, yes, thank you so much for being here and taking our questions. You were talking about the economy as being a very strong economy. You characterized inflation as coming down, employment as being very strong still. However, President Trump, earlier this week, when asked about the market volatility we've been seeing, said the volatility was, quote, to be expected. This is a patient that was very sick. We inherited a terrible economy. A lot of voters did and do agree with that assessment, or at least in part. I'm wondering how you would respond to that assessment and the disconnect between the story of the data and the way a lot of people are feeling about the economy.
Sure. So let me just be clear at the start. I make it a practice not to respond to any elected officials' comments. So I don't want to be seen to be doing that. It's just not appropriate for me. But the situation, I think, is this, and people, when they're surveyed, they are unhappy about the economy. That seems to largely reflect the increase in the price level that happened when inflation was high, 2021, 22, and 23, largely. Inflation is now back down to much more normal levels. Unemployment is low. The economy has been growing, but people are still experiencing that high price level. In other words, prices don't go down. They know they're paying much more for the basic necessities of life. And they're right that they are, and they're not happy about it, and they're right not to be happy about it. So I think that accounts for the negative sentiment. We, of course, we're looking at inflation, which is the change in prices, and we're seeing that that has come down quite a bit, and that, you know, unemployment is actually low. It's sort of very close to measures of maximum employment, and the economy's growing. So all those statistics are good, but you know, the price increases of the past few years are weighing on people's budgets.
So I'm from Milwaukee, and I've been talking to business leaders, executives, and consumers in our community, in our region, for the last few weeks, mostly before this week's news. Chairman, they're troubled and they're nervous. One business owner told me, if there's a hint of a recession, we're cooked. And he asked me to share that with you. What's your response?
So I guess I would say, let's start with the fact that the incoming data right through this morning's employment report, which admittedly is from roughly a month ago, the week of March 12, they took the data, and it still shows us a solid economy. Unemployment's still low. I understand the uncertainty that's weighing on people. You ask about a recession. We don't make a probability forecast of how likely it is for there to be a recession, but many outside forecasters do, and many of them have raised the likelihood, albeit from very low levels. It's not something that anybody now is forecasting, or some people are starting to. And so there's not much more I can say about that. I realize that the uncertainty is high, you know, what we've learned is that the tariffs are higher than anticipated, higher than almost all forecasters predicted. We still don't know where that comes to rest, though, and we're just going to have to see that through.
At a congressional hearing last year, one of the U.S. representatives said that you were pretty boring, and you thanked him and said that you considered that a very high compliment. And in fact, I feel like it's one of the roles of the Federal Reserve, especially since the housing crisis, to be kind of a ballast, especially in the face of the volatility of the markets and the dramatics that we can experience with the economy. Very steady, no surprises, very reliable. In a moment like this, which also has a lot of drama and unpredictability, but it is not necessarily from an economic crisis. It's by design, it's political. How do you see your role in this moment?
So I think all of the values that you touched on are, in fact, the values that we try to live by. You know, we're driven by, you know, analysis and careful thought and discussion and debate, and the merits of things. We try to stay as far as we can from the political process. We don't look at political cycles or things like that. So, and I think people expect that from us. They expect us to tell the truth, and that's what we're going to do. But at the same time, we don't want to be part of the broader political discussion about the wisdom of policies that are not assigned to us. We're not responsible for trade policy, immigration policy, fiscal policy. So we don't comment on those. Decisions are made by others, and what we do is we use our tools to try to achieve the goals that Congress assigned us, which is maximum employment and price stability. So I like to think that over time we're a source of calm, rational analysis and also of stability. That's really what the business that we're in is, providing financial and macroeconomic stability to the public. That's really our purpose.
So how can businesses and individuals and the Fed make plans for the future when so much is being dictated by the actions of a single person? And do you see yourself as the consoler-in-chief on economic matters?
No, I think, take a step back. What's happening is, as I mentioned, the new administration is making, you know, significant policy changes in trade, immigration, fiscal policy, and regulation. And you're still just a couple of months into the administration, and that process will take place. And at a certain point, the new policies will be on the table. They will be having the effects they're going to have on the economy, and uncertainty will decline. Right now, there's a lot of uncertainty about where all that's going to sort out, the forms it will take, and what the economic effects will be. If you fast forward a year from now, the uncertainty should be much lower. The actual effects of the policies should then be pretty manifest and clear. So I think I understand why it just is highly uncertain, both what the policies will turn out to be, exactly what they'll turn out to be, and also what their effects will be in the near term. We just have to go through that process, and it is just kind of a manifestation of our election cycle and a new administration coming in with new policies.
I mean, given all of the change happening and the fact that we are in a period where things have not settled in yet, and that the Federal Reserve and you as chair are very projection, data-driven, policy-driven, how do you handle a moment like now? I mean, can you tweak your plans and projections? Do you just do you have to reset them?
So, what we've had since in the last few months is from the staff has been a placeholder. Rather, they wouldn't call it a forecast because it's so uncertain. They call it a placeholder, and that's kind of how we've been thinking about it. So it's a good time to take a step back and let things clarify. That's why it's just too soon to say what the appropriate monetary policy response will be to these new policies. It is just too soon to say. We can't say with any confidence today. So that's what we're doing. We've taken a step back, and we're watching to see what the policies turn out to be and the ways in which they will affect the economy, and then we'll be able to act. Fortunately, our policy stance is in a good place for us to do that. We're probably moderately restrictive, let's say, so it's not really tight policy, but which is appropriate since inflation is a bit above target. So we think we're well positioned to address whatever may come. And in the meantime, I'd say we're waiting for greater clarity before we consider adjustments.
Business owners in Wisconsin have told me that they can't make their plans. They want to expand. They want to build a new facility. They want to hire.